Ever feel like the stock market is speaking a language you haven't learned yet? Well, today we're handing you the Rosetta Stone. Welcome to the deep dive, where we definitely don't just skim the surface.
Today, we're really diving into some essential trading concepts, especially for beginners. Our source is a pretty clear tutorial aimed right at novice traders, and our mission really is to pull out the core knowledge, the practical stuff you need to know.
Think of it as your shortcut.
Exactly, a shortcut to understanding these key principles and tools, but, without all the confusing jargon.
Okay, so let's kick things off. The tutorial starts with the idea of a trend. Now, we kind of know trends in daily life, right? Something popular.
Right. In trading, it's simpler. It's just the general direction the price is heading, uptrend, downtrend, or sideways.
Uptrend, downtrend, sideways. Got it.
Yeah, so an uptrend is when prices are generally climbing. You'll see higher highs and higher lows on a chart. Think of it as buyers being more in control.
Pushing it up.
Exactly. Then the opposite is a downtrend. Prices are generally falling, making lower highs and lower lows. That's sellers dominating. And then there's the sideways trend. The price just sort of bounces around within a certain range.
Yeah.
It shows the market can't really decide which way to go.
Yeah.
Indecision.
Okay, so how do you actually see these on a chart? The tutorial mentions candlestick charts like you'd find on TradingView or similar platforms. For an uptrend, I guess you'd connect the lows, like drawing a line upwards.
Precisely. You connect those higher lows and the line slopes up. For a downtrend, you connect the lower highs and the line slopes down.
And sideways is just flat between two lines.
Pretty much, yeah. It often looks like the price is trapped between a floor and a ceiling. And, to feel more confident about the trend you think you're seeing, it helps to use other tools like moving averages. We'll get to those.
Oh, okay.
If the price stays above a rising moving average, for instance, that adds weight to the uptrend idea. But why should you, as a beginner, care so much about these trends?
Right, the practical side. The tutorial really hammers home trading with the trend. I mean, it makes sense, doesn't it?
It does. Higher probability.
Yeah, if the price is generally going up, betting it'll keep going up seems like the sleeper play, statistically speaking. The tutorial actually warns against trying to fight strong trends, particularly when you're new.
Definitely. Trend reversal trading is a more advanced game.
And what about those sideways markets?
That opens up range trading. Basically, you try to buy near the bottom of the range support and sell near the top resistance.
Okay, so you just mentioned support and resistance. That seems like the next logical step.
It is. They're fundamental. Think of support as a price floor. It's a level where buyers tend to step in and stop the price from falling further.
Like a safety net.
Sort of, yeah. And resistance is the opposite. It's a price ceiling. Selling pressure usually kicks in there and stops the price from rising higher.
And the tutorial mentioned these levels appear on different time frames. Short term, long term.
Exactly. You've got short-term levels on, say, daily or even hourly charts. Maybe a stock holds $50 support for a few days. Useful for day traders.
Okay.
Then medium term on weekly charts, perhaps $60 acts as resistance for weeks. That's key for swing trading.
And long term.
Monthly charts. You might see support at $40 hold for years. That's crucial for long-term investors.
So how do you find these levels? Just looking back at the chart.
Pretty much. Look for where the price has historically bounced up from. That's potential support. Or where it's struggled to break through potential resistance. You can draw horizontal lines on your chart.
And volume matters here too, right?
Every time. The tutorial points out that if you see a big spike in trading volume when the price hits one of these levels, it suggests that level is stronger. More people are interested there.
So the actionable advice for you, the listener. The tutorial suggests looking to buy near support. Maybe wait for a bullish candlestick pattern as confirmation.
Good idea.
Yeah.
And conversely, consider selling or maybe shorting near resistance if the price looks like it's hitting a wall.
But what about when it doesn't hold? When it breaks through?
Breakouts. That's key. When the price decisively moves above resistance or below support, especially with high volume, it can signal a new trend is starting.
And you also mentioned using these levels for stop losses.
Absolutely critical.
Yeah.
If you buy near support, you typically place your stop loss order just below that support level to limit your potential loss if you're wrong.
Okay, got it. Now, let's shift gears a bit to market sentiment, bullish and bearish.
Right. Simple concepts, really. Bullish just means you expect prices to go up. Buyers are optimistic.
Think horns up like a bull.
Exactly. And bearish means you expect prices to fall. Sellers are in control, pushing things down, like a bear swiping downwards.
How do you actually gauge this sentiment?
Well, the trends we discussed are a big clue. An uptrend is bullish, a downtrend is bearish. Breakouts above resistance are bullish signals. Good company news, strong earnings, also bullish.
And specific chart patterns, too, like bullish engulfing.
Yes, certain candlestick patterns suggest shifts in momentum. Bullish engulfing is one. On the flip side, bearish signals include downtrends, breakdowns below support, bad news, and patterns like bearish engulfing.
So knowing the sentiment helps you decide which way to trade.
Ideally, yes. The tutorial suggests aligning your trades with the prevailing sentiment. Go long if it's bullish, consider going short if it's bearish.
And use these signals for timing, like wait for that bullish breakout before jumping in.
Exactly. It adds another layer of confirmation to your trade idea.
Okay, you've said going long and going short a few times. Let's break those down.
Sure, going long is the straightforward one. You buy something, hoping the price goes up, then you sell it for a profit. Buy low, sell high.
The classic approach.
The classic going short or short selling is a bit different. You're essentially betting the price will fall.
How does that work?
You borrow shares of a stock you think is overpriced. You immediately sell those borrowed shares on the market. Then, if you're right and the price drops, you buy back the same number of shares at the new lower price and return them to the lender. The difference between where you sold them and where you bought them back is your profit. Sell high, buy low.
Interesting. So long for uptrends, short for downtrends.
Generally, yes. That's the typical alignment. Long fits bullish markets, short fits bearish ones.
And the tutorial mentions something about needing a special account for shorting and risk.
Right. Shorting usually requires a margin account because you're borrowing. And the risk, well, it's significant.
How so?
When you buy a stock, go long. The most you can lose is what you invested if the price goes to zero. But when you short sell, there's theoretically no limit to how high a stock price can go.
Oh, wow. So your potential loss is unlimited.
Technically, yes. That's why the tutorial stresses using stop-loss orders, especially when shorting. You absolutely need that safety net to cap potential losses if the price skyrockets against you.
Makes sense. And it also suggested using indicators to help time these entries.
Yes, things like RSI and moving averages, which we should probably get into now.
Perfect timing. Let's start with the moving average, or MA.
Okay, so a moving average is basically a way to smooth out the price data. It calculates an average price over a specific period, like the last 50 days.
Why smooth it out?
It helps you see the underlying trend more clearly by filtering out the day-to-day noise or random fluctuations.
And there are different types, simple and exponential.
That's right. The simple moving average, SMA, just takes the straight average over the chosen period. A 50-day SMA is the average closing price of the last 50 days. The exponential moving average, EMA, is similar, but it gives more weight to the most recent prices. This makes it react a bit faster to new price changes.
Okay, so how do I use these on a chart? What am I looking for?
Generally, if the price is staying above a rising moving average, that confirms an uptrend. If it's staying below a falling moving average, that confirms a downtrend.
Simple enough. What about crossovers?
Yeah. A bullish crossover is when a shorter-term MA crosses above a longer-term MA. For example, the 20-day EMA crossing above the 50-day ENM. That could be a buy signal for some traders.
And a bearish one is the opposite. Short-term crossing below long-term.
Exactly. A potential sell signal. And different traders use different periods. Day traders might use very short MAs, while investors look at the 50-day or 200-day.
So MAs are good for trend confirmation and maybe spotting entry-exit signals.
Precisely. They're a popular tool for those reasons. Common ones are the 20, 50, and 200 period MAs.
All right, next up in the tutorial, Bollinger Bands. These sound a bit more technical.
They can seem that way, but the concept is fairly intuitive. You have three lines. A middle line, which is usually a 20-day SMA.
Like a moving average.
Right. Then you have an upper band and a lower band plotted above and below the middle line. These outer bands are typically set 2 standard deviations away from the middle band.
Standard deviation. That's about how spread out the prices are, right?
Yeah.
Volatility.
Exactly. So the bands automatically widen when volatility increases and narrow when volatility decreases. They measure the market's recent liveliness.
So what do narrow bands tell you?
Low volatility. Sometimes the tutorial notes this quiet period can happen right before a big price move, like the market coiling up.
And wide bands. High volatility, obviously.
Yep. Now, if the price touches the upper band, some might see that as potentially overbought, maybe due for a pullback. Touching the lower band could suggest oversold, maybe ready for a bounce.
But the tutorial warned about just trading touches, didn't it?
It did. Big caution there. Don't just buy because it hit the lower band or sell because it hit the upper. It needs confirmation from other things like the RSI. or the overall trend.
So maybe useful in range-bound markets. Buy near the bottom, sell near the top.
That's one application mentioned, yes.
Yeah.
Also, a strong price break outside the bands above the upper or below the lower might signal the start of a powerful new move. But again, look for confirmation.
Okay. Next indicator, the Relative Strength Index, or RSI.
Right, the RSI. This is a momentum indicator. It measures the speed and change of price movements.
And it goes from 0 to 100.
Correct. The key idea is to identify potential overbought or oversold conditions.
How? What levels matter?
Generally, readings above 70 are considered overbought. It suggests the buying momentum might be getting exhausted and a reversal down could be coming. Readings below 30 are considered oversold, selling pressure might be fading, and a bounce higher could be on the cards.
And the tutorial mentioned divergence.
Yes, divergence is interesting. It's when the price makes a new high, but the RSI fails to make a new high alongside it. Or the price makes a new low, but the RSI makes a higher low.
What does that mean?
It suggests the momentum isn't confirming the price move. So if price hits a new high, but RSI momentum is weaker than before, it could be a warning sign that the uptrend is losing steam, a potential reversal signal.
So RSI helps with timing entries and exits. Buy below 30 when it turns up.
That's one way it's used, yeah. But again, like Bollinger Bands, the tutorial strongly advises using it with other analysis. Don't trade on RSI alone. Confirm with trends, support resistance. It's a helper tool, not a magic bullet.
Got it. Helper tool. Okay, next one sounds interesting. Average Directional Index, or ADX. This measures trend strength.
Exactly. The key thing about ADX is it tells you how strong the trend is, but not which direction it's going. It ranges from 0 to 100.
So a high ADX could be a strong uptrend or a strong downtrend.
Precisely. Generally, an ADX reading above 25 suggests strong trend is in place. Doesn't matter if it's up or down, just that there's a clear direction with force behind it.
And below 20.
That usually means a weak trend, or no real trend at all, like a sideways choppy market.
What about a rising ADX?
That means the current trend, whatever direction it is getting stronger, gaining momentum.
And there are other lines with it, plus DI and anti-DI.
Yes, those help with direction. If the plus DI, positive directional indicator line, is above the DI, negative directional indicator line, it suggests bullish strength is dominant. If DI is above plus DI, bear strength is dominant.
Okay, so how do you put this together for trading?
The tutorial suggests using ADX mainly for confirmation. First, check if ADX is above 25, is there a strong trend worth trading? If yes, then look at the DI lines to see the direction. If plus DI is higher, look for long trades. If DI is higher, look for short trades.
And if ADX is low, like below 20?
Then trend-following strategies probably won't work well. The tutorial advises avoiding them in those weak trend, choppy conditions.
Right, don't try to follow a trend that isn't there. Makes sense. Okay, last individual indicator, super trend.
Yeah, super trend is designed to be quite straightforward. It's a trend-following indicator that plots a line either above or below the price.
So it gives clear signals.
That's the idea. If the super trend line is below the price, it's generally considered a bullish signal time to potentially buy or hold longs.
And if it's above the price?
That's bearish. A potential signal to sell or look for short opportunities.
What happens when it flips?
When the line flips from below the price to above it, or vice versa, that's often interpreted as a potential trend change.
Are there standard settings?
The tutorial mentions common defaults like period 10, multiplier 3, but traders can adjust these. Like other trend tools, it works best when there's actually a trend. So again, maybe check the ADX first. If ADX is above 25, then the super trend signals might be more reliable.
Can you combine it with support resistance too?
Absolutely. Using it with other tools is always recommended. One interesting use mentioned is for trailing stop losses.
How does that work?
If you're in a long trade and the price is rising, you can trail your stop loss order just below the super trend line as it moves up. If the price eventually breaks below the super trend, you get stopped out, hopefully locking in profit.
But it has weaknesses.
Yes, the tutorial cautions it can give lots of false signals in choppy sideways markets. It needs a trend to work well.
Okay, wow, that's a lot of individual tools. But the tutorial really stressed combining everything, didn't it?
Absolutely. That's probably the most crucial takeaway. Don't rely on just one indicator. Use several together for confirmation.
To reduce false signals.
Exactly. So for trend identification, you might look at moving averages, ADX, and super trend together. Do they all agree?
And for finding entry points.
The tutorial gave good examples, like in an uptrend. Look for a pullback to support. Maybe see the RSI get oversold and turn up, plus get a bullish MA crossover, and see the super trend flip to buy, and check that ADX shows a strong trend with plus DI dominant.
So layering the signal.
Layering them. Similar process for downtrends, just looking for the opposite signals resistance, RSI overbought, bearish crossover, super trend sell, strong ADX with neat DI dominant.
What about sideways markets?
There, the focus shifts. Maybe use Bollinger Bands, buy near the lower band, sell near the upper, and confirm with RSI showing oversold near the bottom or overbought near the top.
So the core idea is confirmation. The more things line up, the better the potential trade.
That's the principle. It increases confidence and helps filter out market noise. For exit points, you could target resistance for longs, support for shorts, or use Bollinger Bands again, maybe exit if price hits the opposite band, or exit if RSI hits an extreme level.
The tutorial had a detailed example strategy too, right?
It did. It walked through a potential long trade in an uptrend, combining an EMA for the trend, ADX and DI lines for strength and direction, waiting for a pullback to support, or a Bollinger Band.
Checking the RSI.
Checking RSI for an oversold reading, turning up, getting a super trend buy signal, and then crucially setting the stop loss below support and having a profit target at resistance.
That really shows how you piece it all together.
Right. It's not about finding one magic signal. It's about building a case for a trade using multiple complementary pieces of evidence.
Yeah.
A system.
And a huge part of any system, as the tutorial stressed, is the stop loss.
Cannot emphasize this enough. A stop loss is just an automatic order you place with your broker to sell your position if the price hits a certain level. Its only job is to limit your loss.
Protect your capital. How do you decide where to put it?
The common ways are just below a key support level if you're long, or just above a key resistance level if you're short. You could also use recent price lows or a certain distance below a moving average. Some people use a fixed percentage, like 2% below entry, but that needs care depending on volatility.
Right, a very volatile stock might need a wider stop just to avoid getting shaken out by normal noise.
Exactly. But the point is, you must have one. It protects your capital, and it takes the emotion out of taking a loss. If the level is hit, the order executes. Done. It's fundamental risk management.
Okay, speaking of risk, that leads to the risk-reward ratio.
Another crucial concept. This is all about asking, is this trade worth the risk I'm taking? You compare your potential loss to your potential gain.
How do you calculate that? Simple calculation. Your risk is the distance from your entry price down to your stop-loss price. Your reward is the distance from your entry price up to your profit target price. The ratio is just reward divided by risk. So if you risk $2 per share to potentially make $6 per share, your reward, $6 divided by your risk, $2, gives you a 3.1 ratio.
And a tutorial suggested aiming for at least 2.1 or 3.1.
Yes, that's a common guideline. You want your potential winnings to be significantly larger than your potential losses on any given trade.
Why is that so important?
Because you won't win every trade. Nobody does. But if your winning trades make, say, 3 times more than your losing trades lose, you can actually be wrong more often than you're right and still be profitable overall.
Okay. That makes a lot of sense. It builds in a buffer.
Exactly. It forces you to be selective and only take trades where the potential payoff justifies the risk.
All right. Next piece of the puzzle. Position sizing. How much money to put on a single trade? Yeah, this is critical for survival. The core rule the tutorial gives is never risk more than a small percentage of your total trading capital on one trade.
Like 1% or 2%?
That's the standard advice, yes. So if you have a $10,000 account, you shouldn't risk more than $100 or $200 on any single trade.
How does that translate into how many shares to buy?
You work backwards. First, decide your risk amount in dollars, e.g. $100. Then figure out your risk per share, entry price minus stop loss price, say $2. Then divide the total risk amount by the risk per share. So $100 risk divided by $2 risk per share means you can trade 50 shares. That's your position size for that specific trade setup.
So position sizing links your account size to your stop loss distance for each trade.
Perfectly put. It ensures that even if your stop loss gets hit, the loss is only that small predefined percentage of your total capital. It prevents catastrophic losses from one bad trade. Absolutely vital for staying in the game.
Which brings us to the big umbrella concept, risk management.
Yes, this ties everything together. Risk management isn't just one thing. It's the whole set of rules and practices you use to protect your capital and ensure you can trade long term.
What are the key principles again?
Limit risk per trade, that's position sizing. Always use stop losses. Diversify your trades where possible. Only take trades with a good risk-reward ratio. Avoid overtrading, which is often emotional. And constantly review your trades. Learn what works and what doesn't.
It sounds like discipline is the key theme here.
It really is. Risk management is what separates gamblers from traders. It's about treating trading like a business, focusing on preserving capital so you can keep trading and let your edge play out over time. So the foundation for everything else.
Okay. And finally, the tutorial wrapped up with some really practical tips for novice traders.
Yeah, great starting points. First off, start small. Use a demo account with fake money first, or trade tiny amounts of real money. Get your feet wet without risking much.
Makes sense. Learn the ropes safely.
Second, use a good trading platform, something like TradingView or MetaTrader, that gives you the charts and indicators you need.
Third, keep a trading journal. This is huge. Write down why you took a trade, what happened, what you learned. It forces you to be accountable and find patterns in your own behavior.
Fourth, stay disciplined. Stick to your plan. Follow your risk rules. Don't chase losses or get greedy. Easier said than done, but critical.
Very true. Emotion is the enemy sometimes.
Often. And finally, learn continuously. Markets change. Keep reading, keep studying charts, learn from others. It's an ongoing process.
Great advice. So, wrapping up our deep dive today, the main takeaway feels like understanding these core ideas, trends, support resistance, indicators, and especially risk management is really that essential first step.
It absolutely is. It gives you a framework, a language to start understanding what the market might be telling you and how to approach it with a plan, not just a guess.
You can now, hopefully, speak a bit more of the market's language, as we said at the start.
You've got the building blocks for analyzing price and managing risk.
So we'll leave you with a couple of thoughts. Now that you have this foundation, which specific tool are you maybe most curious about? How could you start playing with it, perhaps in a demo account?
Or thinking about that crucial risk management piece. What's one specific rule, maybe about stop losses or position size, that you will absolutely commit to as you continue learning, something to really anchor your approach.
Food for thought.
Yeah.
Definitely keep exploring.